Hello and welcome to Absolute Trust Talk. I'm Kirsten Howe, and I am the host of Absolute Trust Talk, which is our podcast here at Absolute Trust Council. And today we have our third episode with my guest, Miguel Delgado. And Miguel is a certified financial planner and a senior wealth advisor at Legacy Wealth Management. He works with owners of privately held businesses and also with high-performing professionals who are looking to find a way to either slow down or just spend more time doing the things they love. And by now, if you've listened to the prior two episodes, you have heard or seen a lot about Miguel. You already know his credentials. You already know what a knowledgeable advisor he is. So I'm just going to share a little bit about him as a person, since we're talking about helping his clients do more of what they love. On top of his professional life, Miguel is a proud father and husband, and he is passionate about a few things: nature, classical guitar, and personal growth, one of my favorite things. He loves hiking, especially while he's alone. He is a firm believer that a combination of fresh air and solitude lead to great ideas, clarity, and inspiration, and I echo that. Miguel, welcome, first of all, and thank you so much for being here and for doing 3 episodes. That's very impressive. We greatly appreciate it.
Well, I'm honored. Thank you.
Okay, so we have been talking about the financial planning that you do with business owners. Let's shift over a little to the personal financial planning in this episode. And I want to talk about diversification, which is a term we hear all the time. And with respect to a typical stock and bond investment style portfolio, what does that word diversification mean?
Diversification in the context of stocks and bonds and really the traditional investment world is another word for diversification is asset allocation, right? And that is we've all heard the saying, "Don't put all your eggs in one basket." So this is investing in multiple types of stocks, multiple types of bonds. And what that means is investing in maybe U.S. and foreign stocks. There's large cap, there's mid cap and small cap. There's different styles of stocks, some that are more cyclical, maybe healthcare related, different industries. And so the more broadly diversified, the more you're allocating into all these different mixes, is how you achieve that diversification. Same thing with bonds. There's bonds that have a higher rating versus lower rating, some that have longer duration periods and shorter duration periods, higher yields, lower yields. And so you have this whole basket universe of stocks and bonds. And so when you invest in all of them across the board is typically the idea of how you achieve diversification.
And the interesting thing that I wanted to talk to you about, it goes beyond that. And I heard you use the term meaningful diversification, which means something beyond what you just described. And it's a little different than what the typical investment advisor is going to be talking to their clients about. So let's hear it.
Yeah. I learned, and I think most advisors learned that a well-diversified portfolio is everything I just mentioned earlier, right? A mix of different stocks and bonds. The whole added, don't put all your eggs in one basket. But for some clients, that's not enough because diversification against all of those different stocks and all those different bonds, we're still invested in a very similar type of asset class that's correlated to the stock market, right? All stocks, regardless of the style or how large they are, they're traded on an exchange, at least most of them are, and their value changes daily, sometimes second by second, right? So could be a lot of volatility with that. And so some clients really look at something called alternative investments. And so alternative investments are types of investments that are uncorrelated to the stock market and the bond market. So these could be things like owning real estate outside of your portfolio. One of the reasons why people even look at diversification to begin with is to try to lower risk, right? Everybody wants to live in a world where we can achieve the highest returns with the least risk possible. And so that's the premise of diversifying a portfolio. If we weren't concerned with risk, we put all our money on NVIDIA or the S&P 500, for example. Don't do that. That's not my advice. We're not recommending that. But the diversification is to achieve something goes into what's called the efficient frontier. It's a little bit more analytical here. I'm not going to go too deep into this, but what the efficient frontier says is it allows us to be able to build a portfolio that considers both the risk of the investment and the return. So we can plot different investments on this graph, if you will. And by using alternative investments, we can drastically reduce the volatility because they're not going in the same direction as stocks are with the stock market. If the stock market crashes, for example, that doesn't necessarily mean that the real estate market is crashing. That doesn't necessarily mean that oil and gas is crashing, or all these other different types of industries. And so meaningful diversification to me is going outside of the traditional world of stocks and bonds and really looking at alternative investments, real estate, and various other instruments that can more meaningfully diversify the portfolio.
And when we're talking about alternative investments as not being correlated to the traditional stock markets, the publicly traded markets, is that part of the reduced volatility? Part of it comes from simply the fact that they aren't publicly traded. You can't just click a button and your deal is done. And I mean, I'm stumbling. I think some of the volatility in the publicly traded markets is due to the ease of trading and how quickly the trades can happen. News comes across from CNN or TikTok or whatever, and all of a sudden there's a big swing on a particular investment.
You're right. Stocks could be susceptible to risk for a variety of different forms. It could be geopolitical risk, could be market risk itself. Maybe their cash flow performance wasn't good. Maybe they had some layoffs. Maybe there was a bad press. Whatever it could be. So there could be more susceptible. Interest rates, as we saw in
Sure.
2020. Very recently, can affect valuations as well as bond prices and yields. So alternative investments, not to say that they're shielded from that, but they're not always going to be affected by those same types of risks. And maybe they are, but under different frames of context, if you will. For example, there might be geopolitical risk that affects certain types of stocks, but that same geopolitical risk isn't going to affect maybe oil and gas, for example, because it's a completely different type of industry.
Mm-hmm. Well, and we have seen that some geopolitical things cause the entire stock market to go down. I'm thinking in particular about when the Russians invaded Ukraine. That was a big deal across the board, I think, in the stock market.
Right. And another aspect of how risk is reduced with alternative investments is you're right. A lot of these alternative investments are not traded daily. Some of them are privately held and it's often held for a long period of time. It could be 1 year up to 10 years or even more. And so we're not seeing that same level of volatility. That's one aspect. But we're also looking at a sponsor or alternative investment companies that have a good track record that may have done a real estate project, let's just say, and maybe this is their 100th real estate project, and maybe they had a small number that failed in the past, but we understand why those investments failed. The probability of that reoccurring under the current circumstances that we have may be less likely, for example, right? So it also comes down to the management of those investments themselves as well.
Okay, and so anybody can buy publicly traded stock. I think that these alternative investments are for a particular type of investor. Do you want to talk about that?
Yeah, they very much are. So you're right. A lot of this, unfortunately, has to do with access, right? And I say unfortunately because it takes me back to what I wanted to be an attorney to be able to help people who didn't have access to the right kind of help. And so, but it is true, right? Once we reach a certain level of income or a certain level of net worth, all of a sudden these doors open up to tools that most people don't even know exist. And so, to qualify for some of these investments, the first level is what's called an accredited investor. And so, an accredited investor can qualify as such in one of two ways, either through income or through their net worth. If we're looking at income, if they're single, they have to be making at least $200,000 a year or more. If they're married and filing jointly, then they have to be making $300,000 or more. So from an income level, that's how you qualify as an accredited investor. On a asset level, you have to have at least $1 million of net worth, excluding the primary residence. So you can include 401ks, other real estate properties. Take all of those assets, subtract the debts that you have, get your net worth. If it's over $1 million, then you might be eligible for that.
Okay, and these are SEC requirements. The Securities and Exchange Commission is protecting those who are less affluent from making these investments.
Correct. And then it's up to the advisor to, if you're working with an RIA, you're working with a fiduciary. If you're working with an RIA who's also a CFP, it's almost like a double fiduciary, if you will. But it's up to the advisor then to kind of do the extra legwork and making sure that, sure, even though you meet the requirements of an accredited investor, does this mean that it's a suitable investment for you? Maybe, maybe not. Then you look at concentration limits. Let's say somebody's worth 2 million, but maybe that's all of their assets. Should we invest all of that $2 million into alternative investments? Maybe not, right? So there's concentration limits as to how much we should allocate to the alternative investment world in itself, and into even to the degree of how much should I invest into one alternative investment, right?
Right.
Yeah.
Right. Yeah. Just because you are an accredited investor doesn't mean you should go all in on anything, or your financial advisor still has to look at it and figure out, is this the right thing for you?
That's right.
Okay. So aside from, we talked about volatility, but aside from that, what other kinds of I'll say maybe solutions do these alternative investments offer to a potential investor?
Right. So we talked a little bit about the reduction of risk, and I want to note something about this. Risk is reduced not because alternative investments are safer. By no degree is that an accurate statement. But it goes back to the theory of diversification, right? Going back, if you want to read about what the efficient frontier is, by meaningfully diversifying the portfolio, we're able to spread risk, and that's how risk can be reduced. Standard deviation can be reduced. So that's a big achievement. These investments, again, have little to no correlation with the stock market or the bond market. Some of these investments can provide some pretty significant tax strategies that, if used properly, can help people save money in taxes in ways that they didn't even think were possible. And we can. Another benefit is that you can invest into some projects directly and have an impact on communities. There's investment projects that are designed. They're called value add. So think about maybe there's we've seen vacant malls around the Bay Area, or shopping centers that just look like they're dying or have already died.
Yeah.
So there are investment companies out there that are looking at these plots of land and saying, well, what's needed in this community? Maybe it's more housing. So should we redevelop this land into housing? Maybe more affordable housing, maybe housing that has shopping areas that people actually want, right? And so those types of value add. So you can invest in projects like that have an impact either in the community that you live or in other communities that you'd like to invest in.
Okay. All right. Well, so we've been talking about alternative investments. Why don't we take a look at a couple of different types and talk about the possible tax strategies or other benefits that they might offer?
Okay, yeah, let's do that. So there's lots of options. We'll start off, let's talk about drilling funds. These are drilling funds into oil and gas. One of the major tax benefits with these investments is that you can get potentially a tax deduction for the investment that goes into these projects. What they use is what are called IDCs, intangible drilling costs. And so these expenses can be passed on to the investor as a loss, essentially. And so that results into a tax deduction. Depending on the drilling fund that you go in, these tax deductions can range anywhere from, say, at the very least, somewhere around 30%, at the very highest, maybe 90%. And so if I'm an investor and I invest $100,000 into one of these investments and I'm at the highest tax bracket, I could potentially save anywhere from $30,000 to $45,000 in taxes for that one investment, depending on, again, what the tax deduction is, what my tax bracket is, and all of that. And this is something that we usually discuss with investors, CPAs, or their accountants to make sure that it's a suitable investment for them. These investments, sorry, go ahead.
No, I just was going to say, I mean, I can imagine that there could be situations where the client has some kind of event on the other side of the ledger that's happening, that it would be really nice if I could somehow get a tax deduction. Like,
yes,
having a taxable event this year, wouldn't it be great if somehow I could get a tax deduction?
Exactly. And so a great place where this could be a good fit is somebody who had an extraordinary high income year. Maybe they got a much bigger bonus that they anticipated. Maybe they got their salary, their bonus, and some stock options. And so if they're in a year where they feel like they've made more money than they normally did, and maybe next year isn't going to be exactly the same, a drilling fund could be a good option to consider because it could bring them back. It could bring their tax liability down, even for somebody who's a W-2 employee. Who normally thinks I've maxed out everything already. There's nothing else I can do. Drilling funds can be something they can look at. And there's limitations to that, but that could be something they look at as well.
Okay, Miguel, let's talk about a few other examples. I know you've mentioned to me the QOZ, you call it, I think that's Qualified Opportunity Zone.
Yes.
Did I get that right? Okay.
Got it.
So talk to us about what that means and what the possible benefits of that kind of an investment could be.
The QOZ is kind of I like to think of it as a cousin of the 1031 exchange in the sense that it allows you to defer taxes for an event where capital gain is triggered. The difference from a 1031 exchange and a QOZ or qualified opportunity zone is that in a QOZ, you can defer the tax of a capital gain of any kind. It could be a personal investment like your personal residence. It could be stocks. It could be real estate. It could be gold, cryptocurrency. If anybody has had any kind of capital gain, whether it's short term, long term, personal, or business investment grade, that could be deferred into by using a qualified opportunity zone. The law came about back in 2017, and it was only intended to last about 10 years, and legislation hasn't passed anything new yet to extend it. But the way it works currently, let's say I have an asset, it could be any kind of asset, and I bought it for $100,000. Now the asset's worth, let's say, a million. So I have $900,000 of gain. If I sell that asset, I'm going to have to pay taxes on that 900,000. If you're in California, you're paying taxes on that and also federal. So if we use a qualified opportunity zone, I could take that $900,000, invest that in a qualified opportunity zone investment, a fund or a private deal. The law requires investors to hold that investment for 10 years inside of that QOZ. But what they're getting is a tax deferral. So this year, the year that the capital gains tax was triggered, is going to be deferred until the end of basically 2026. So we'll have to pay federal taxes in 2027. It gets a little complicated because if we're talking about California, and most of your viewers, I'm guessing, are in California. California, no surprise, does not recognize the tax benefits of a QOZ. So they'll still have to pay capital gains taxes in California. So we're really talking about a federal tax deferral. Unless you live in mostly any other state, we're deferring the whole thing. So
okay.
we defer it for basically 2 years is what we have now. We pay the tax. We hold on to that investment. But the beauty is at the end of the 10 years, when the underlying investment is sold, maybe it's a real estate development project, maybe it's some oil wells or whatever. When that project is sold, the proceeds are received 100% tax free.
Tax-free. Oh, that's fascinating. Okay. Mm-hmm. I like that. And you referred to 1031 kind of as a comparison to the QOZ. 1031s, I'm going to ask you to talk about, but that is specifically involving real estate.
Right. Investment real estate.
Okay. So talk a little bit about that as an approach to alternative investment.
Yeah, so the 1031 exchanges, where I typically get involved in that, are when there's investors who, and these are typically people in their 50s, 60s, or 70s who may have owned real estate for a long time. They want to exit for a variety of reasons. They're either tired of managing the property, they need to refinance, but interest rates are too high. They need to retire, and they need the cash. It could be a variety of reasons. So, but what's preventing them from selling in the situation that I'm involved is they don't want to do an exchange. They don't want to pay the tax, and they don't want to do an exchange where they have to exchange it for another property that they're now managing. Right. So we have access to things called Delaware statutory trusts. It's a different form of investment. I won't go into the full details of that here, but it's a like-kind exchange. It allows them to be able to go into another real estate asset where they don't have any management responsibilities. And we in the industry like to refer to it as mailbox money because essentially they're investing in real estate, usually AAA rated or investment grade real estate. where we're able to oftentimes provide them with better cash flow. If you have somebody who was renting out some properties and their cash on cash return was maybe 1% or 2% after paying the mortgage and property taxes and property management, a lot of these DSTs are paying anywhere from 3 to 6% in annual income. So the DSTs allow for us to be able to do that, but where that's different from a QOZ again is the QOZs is any asset. The Delaware Statutory Trust is only for investment grade real estate, and I have some examples that I can share as well.
Sure. Okay, so the QOZ can be used for any type of asset, including real estate, whereas the 1031 is only for real estate. How would you decide when the asset is real estate, whether a 1031 or a QOZ is the better approach?
That's a really good question because it comes up a lot. Usually when investors, real estate investors are thinking about selling a property and they're trying to defer tax, the thing that comes to mind either by them or some of their advisors is utilizing a Delaware Statutory Trust. But a lot of times, a qualified opportunity zone could be worth exploring because it comes down to control. When you do a 1031 exchange, let's say I have a $1 million property and my capital gains on that is whatever, $500,000. If I want to successfully defer 100% of that gain, I have to replace that investment real estate with another $1 million property, at least. I can always go above or below. But if I want to fully defer the tax, I have $1 million property that got sold and I received the proceeds, I have to replace it with something that's also worth at least $1 million. But maybe that business owner doesn't want to do that. Maybe they want some control over how the cash is spent. Maybe they want to sell the property, not pay the taxes on the $500,000, and then spend the remaining $500,000 cash into something else. And so a qualified opportunity zone might be able to help them with that because in that same example, where somebody owns $1 million property, let's just say, and they have a $500,000 capital gain, rather than investing $1 million into the qualified opportunity zone, they only have to invest $500,000 because that's the capital gain, and then the rest, that remaining $500,000, they could do whatever they want with that. That's their cost basis, right?
Got it, right.
So it gives them more control. And so when presented both options, many investors choose to go with the qualified opportunity zone for that reason. It gives them more control. Not to mention, now they'll be getting a tax-free asset down the road.
Right. Okay. Thank you for that explanation. I did not appreciate that from the prior discussion, but you really laid that out very nicely. Thank you. And thank you so much for talking to us about alternative investments. I'm sure this is something that a lot of my listeners know nothing about. And now they know at least enough to start thinking about it and possibly start thinking about maybe they should talk to you. Miguel, I really appreciate you being here with us for these 3 episodes. They've been so informative. Thank you very, very much.
Oh, well, thank you for having me.
And thank you all for watching, for listening. We appreciate your interest, and we look forward to connecting with you next time.
Thank you for joining us today for another episode of Absolute Trust Talk Live. If you enjoyed listening in, then don't forget to subscribe. You can find us on Apple Podcasts or wherever you may listen by searching Absolute Trust Talk. While you're there, we would also love for you to leave us a review. And then why not share your favorite episodes with family, friends, or colleagues too? You can find all of our shows and corresponding show notes by visiting absolutetrustcouncil.com. You'll also find a variety of other free resources, including our ebooks, videos, blogs, presentations, and more. If you need help with your estate planning or administration, we also offer a free discovery call to help get the process started. You can find more information on booking your session by visiting absolutetrustcouncil.com/scheduling. Don't forget to keep an eye out for our next live episode. If you join us for the broadcast, you can submit questions during the show. But if not, don't worry. You can always get in touch with us by sending a quick message to info@absolutetrustcouncil.com. Thanks again for listening. We'll see you soon.